David R. Guttery is an investment advisory representative of Emeritus Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Today I am joined by David Guttery, president of Keystone Financial Group in Trussville, for a discussion about keeping recent market volatility in perspective. Hi David, thanks for joining us.
Thank you for having me.
David, in recent weeks, we have observed a return of volatility to both the stock and the bond markets. What is going on?
Yes, we have, and I wish that I had a simple answer for you. All markets are discounting mechanisms. This means that assumptions about the future are priced into current values. Market valuations of 1 year ago had priced into themselves an assumption about the coming year in terms of economic activity, earnings, interest rates, and other quantifiable metrics. Since that time, we've seen the passage of the Tax Cuts and Jobs Act and the imposition of tariffs. Sometimes it can seem as though a single tweet from the president can cause the market to move by several hundred points. What's really happening is a repricing of risk. To what degree might previous assumptions about the economy change with the imposition of a new tariff? To what degree might it change if the Tax Cuts and Jobs Act was repealed?
Should investors be worried about increased volatility?
That is a question that must be answered relatively. Relative to long-term investment objectives, no. Those with shorter-term investment objectives shouldn't have had a large exposure to the market risk in the first place. You must also consider the relative strength of the underlying economy. The 4-week moving jobless claims average hasn't been this low since October of 1968. The ISM Manufacturing Index and the ISM Non-Manufacturing Index continue to reflect strength and expansion. Housing remains strong. Non-defense capital goods spending remains strong. Consumer confidence and CEO confidence surveys remain at or near record high levels. The underlying economic data, in other words, is robust. In light of that, I would suggest that those with longer-term investment objectives view periods of volatility as a buying opportunity to acquire more shares of companies at lower prices and dilute your cost basis in the process while allowing the natural market forces to work for you.
How do you help clients to keep perspective at times when the market seems to behave irrationally?
First, I remind clients of the objective at hand, the length of time between now and the realization of that objective, and the plan we derived for pursuing that objective. Secondly, I remind clients that markets are often moved by factors that can't be quantified on a spreadsheet. For example, the 10-year Treasury yield spiked recently, and by a faster short-term rate than with which the markets were seemingly comfortable. By historical standards, a flattening yield curve has been a harbinger of recession. Fear over a perceived threat of recession may have outweighed the reality of economic metrics that are suggesting a completely different outcome. During times such as these, financial advisors work with our clients to help with the dispassionate evaluation of current market fundamentals and the recognition of opportunities. Third, we can recall similar recent periods of short-term volatility for clues about what might transpire going forward. If you'll recall, we witnessed a deep and short-lived market correction in February of this year. By the end of the first quarter, the markets had recovered to being nearly unchanged on the year.
So, keeping everything in perspective is the key then, correct?
Absolutely. Turn off the television. Such is a source of sensationalism, and it will continue to be so through the midterm election. The next 500-point decline isn't necessarily the beginning of the next Great Recession. You can only discern the tip of an iceberg from an ice cube if you have a deeper understanding of how markets price risk, what events cause the markets to reprice risk, and an appreciation of the relative economic strength underpinning the market right now. Talk frankly with your financial advisor and share your concerns. but also listen to the dispassionate advice that you receive. You hire a financial advisor to have the intestinal fortitude to guide you through periods of time such as these when the markets seem to behave irrationally. If you are without such counsel or would appreciate a second opinion, I would be happy to meet and hear your concerns.
Thank you, David. For additional information, David may be reached through the means listed upon the following screen. For the Trustville Tribune, I'm Tana Friday.
David R. Guttery independently offers securities and investment advisory services through Ameritas Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risk will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results. Information provided is gathered from sources believed to be reliable. However, we cannot guarantee their accuracy.